Hello, Arizona. Welcome to the Lawgitimate podcast. We are your hosts, Mike and Rochelle Poulton. We're here today to discuss investing in real estate. We have done a number of shows about real estate investment, but this one's going to be a little bit different. Rochelle, tell them what we're doing today.
We're going to cover everything you care about in real estate investing. So we're going to talk about what's going on in the Phoenix market and get into a deep dive on, in our opinion, what are the most important aspects of investing in real estate and, more importantly, not losing money.
Specifically, today is about deal selection and evaluating a real estate investment. In the past, we've talked a lot in sort of generalities about real estate investing and about a few aspects of it, like if you're going to buy a commercial property for your own business or something like that, or if you're going to be a first-time residential landlord, maybe. Well, today we're going to go through some of the key details involved in evaluating particular real estate investments and how you make your money as a real estate investor, what the particular deals are. So, Rochelle, why don't you go ahead? I know you've got some specific notes on the Phoenix market and what's going on here. And that's kind of the reason we're talking about this now, is because of what's going on with the Phoenix market in the last year or so.
Yeah, so real estate prices have been increasing like crazy. And if you've been thinking about buying a home, you may have noticed that it's a little bit difficult. You may have looked at 30 or 40 properties, put in a bunch of offers, and maybe or maybe not been able to actually close on the home that you were hoping to buy. But that doesn't mean that it's not a good time to invest in real estate. It's always a good time to invest in real estate. It depends on the deal. So right now, there are a couple of concerns about maybe the Phoenix market being oversaturated or crashing or something like that. So the first thing that's happening is there have been a lot of price cuts in terms of what's for sale on MLS. You may have seen it on whatever tool you're using to monitor the real estate market, like Zillow. You'll see there's been price cuts. There's been quite a few. Well, people have been experimenting with what is the top of the market. So you may have noticed that maybe your neighbor's house sold for something like $350 a square foot, and another neighbor down the street is now trying to sell theirs for $450. Well, they found the top of the market. So that's why there are price cuts. Sometimes people get a little ambitious in what they're listing their houses for and realizing that, oh, the market doesn't support this, I need to cut it. Or you have some where there has been a lot of deferred maintenance, like too much to justify the price that they've listed it for. And so people are cutting it back because they haven't done anything to the property, no improvements at all. And people just want to see that come down in order to invest in it and to make it what they want. So don't be afraid of price cuts. They are normal in this type of market. We've seen nothing but increasing over the last year. So having a little bit of a cut isn't that big of a deal. And it's not like we're seeing prices slash by $50,000. Like you're seeing, some slashing, but nothing too drastic. Like no one's losing significant percentage of their home value. The second thing I want to talk about is there are a lot more apartments being built in the metro area. Currently, there's about 25,000 units in the pipeline. And that sounds like a lot. And it's like, oh, are we overdeveloping, our rental market? And probably not. I mean, we already kind of have a housing shortage, and we get about 200 people a day that move into the Arizona, period. That's a lot of people. That's like 70,000 people a year.
And notably, almost all of them are coming to the Phoenix metro area. Vast majority of the Arizona population is in the valley here. Vast majority of new residents are moving to the Phoenix area.
So it's going to happen. So we're probably not overdeveloping our housing market. We could use more affordable housing, which means we need more of it. So there's more competition, because right now, rental rates are kind of out of control because we have so many people who move here who don't actually have a place to live. And there's a new fun company coming to town called Nomad. They're from Denver, and they offer a iRenting solution similar to the iBuyer model, which is basically helping landlords secure new tenants. They will guarantee your rent for 2 years. That's pretty awesome. So that's a new service that's coming soon to the Phoenix metro area. So for people who are looking at getting investment properties, but don't necessarily know how to go about screening their own tenants, getting good tenants, this is a company that can help you with placement and do that. Now, there are lots of great property management companies in the Valley, and, like all good things, they all have a purpose. So make sure that you're talking to a bunch of different people to see what's a good fit for you, what gives you the warm fuzzies, and what makes you feel secure in your investment. But that's all I got.
Cool. So let's start off with a couple of basic things here. What is real estate investment? In my opinion, real estate investment is buying or holding real estate as a business activity. What do I mean by that? Well, I mean to define this very broadly, much more broadly than some other people define it. I think if you already own a property and you haven't been looking at it as a business, you haven't been considering it an investment, but you decide today that it's going to be one, and you start making a few spreadsheets and running some numbers on what your potential return is on that property, and you start treating it like a business, you are now doing real estate investment with that property. I think that's fair. And certainly, if you are looking at buying a property you don't already own, and you're evaluating it in terms of its potential financial returns for you, and you're deciding whether or not to buy it and what to do with it based on those numbers, that's real estate investing. And I think it should be that broad. And I think that includes occupying the property yourself. Probably not as your primary residence, although there are circumstances where your primary residence might be an investment property. I consider my primary residence an investment property. I bought it as a probable rental, ended up moving into it. I've lived in it longer than I've lived anywhere else, but I still consider it an investment, and it's been an excellent investment. But especially for business, if you're going to buy a commercial property for your own business, that is an investment. You better look at it that way, because the alternative is renting it. You could rent your space, or you could rent the property you own to somebody else. Either way, it's pretty much a wash business-wise, and you really should run those numbers and treat it like an investment. All right. But what are the approaches to real estate investing? The basic options are these. I think there are four. One is that you buy a property and rent it out to somebody. Very straightforward.
Very traditional.
Yes.
That's the most common type of real estate investing for any type of first timer, is you buy a property and you get a tenant and you rent it out.
Very straightforward, and that can work just fine. Nothing wrong with that. However, it is often not the very most optimal return that you can get, because there are a number of different ways to get a return on your investment, to get it to make money for you. And that's the easiest, but not necessarily the highest return. The next option is to buy, renovate, and rent. So you buy something that's not in great shape, you do some work on it that makes it nicer, and then you rent it for more money than you could have rented it without doing the renovation. That's also pretty straightforward, but there are some tricks in there, and you can really improve your return by doing that sort of thing, because properties that need work sell for less money than properties that have been worked on.
And it's important too that if you are going to, fix up a property for a rental, that you don't spend too much money on the repair costs. Like, you actually need to do a spreadsheet on this. You need to know how much money you can invest into the property, how much it improves it in terms of equity, and then of course, how much you can rent it for compared to what you could rent it for before. So if you're looking at a property that maybe you could have gotten $750 for, but now you can get $1,000, do you put $50,000 into it? I don't know. Look at the math.
Be quite scrupulous. It's easy to over-improve an investment property. If you're not used to this sort of thing, you may look at flips or improved rentals and think that the owners were being really cheap and wonder why they made certain decisions. Now, in some instances, they made bad decisions.
And they did a bad job.
But in other instances, those were very calculated decisions to produce something that's not quite optimal. They could have done a better job, but it wasn't worth it to do a better job. They would have been throwing money away. And when you start doing the analysis on your potential investments, you will find very quickly that that is the case. It's rarely the right thing to do to make it perfect. Only in luxury properties and only in very specific markets. So you got to be real careful about that. Another option: buy, renovate, rent, sell. The rent is optional there. Buy, renovate, sell is a flip. That's easy. Buy, renovate, rent, sell is like a delayed flip. So you do the flip, buy it, renovate it, and then you rent it and hold it for a while, and then you sell it. And you can sell it vacant for somebody to live in, or you can sell that leased as an investment property to another investor. These are great options. This is like the meat and potatoes of standard real estate investment. You buy the property, you improve the property, and you decide when you're going to unload it, but that's when you reap your profits.
So if you're going to do the rent and then sell portion, you have to remember that this is now a rental producing or rental income property. And that means that whoever's buying it may want to actually see your books. Like, they're going to want to know, what did you rent? How much was the rent? What were your operating costs? What are the taxes? What did you spend on repairs? What are the capital improvements that have been made? Because when someone is buying an investment property like a residential rental, they want to know, do I have to put in new money for a new roof? Am I going to have to fix all the plumbing up front? Like, what are the expenses so I can calculate my ROI?
You got to treat it like a business. You got to create those books. And if you want to get optimum value selling it to another investor, you have to be open with that stuff. If you're trying to hide the ball and you won't show them your books on the property, or you just don't even have the numbers, that's going to decrease your market value. It's a red flag. It raises some questions. So those are things to think about. Now,
and if you are going to, buy those types of properties, ask for the books.
Yes. If you're buying an existing leased rental as an investment, do your due diligence. And the due diligence includes looking at the current owner's books running that property as a rental, because you can find all kinds of interesting stuff. And don't just take them at face value either. They may not be accurate. You look at them very skeptically, but get that information and consider it carefully. It's
really important.
Yes.
And you just want to make sure that when it comes to renting and figuring out if you can increase the value, that you're talking to a real estate agent who knows the area, who knows what the rental rates are. Googling it isn't probably your best approach. You really need some very specialized advice on what a property should be renting for and what it could be rented for in the future.
Definitely. Final option: buy, sell. There can be a delay in there, or there can be no delay in there. If you buy and immediately resell, that's wholesaling. You can also characterize it as a few different things, but basically what you're doing there is you think you've got an opportunity to acquire a property at below its current market value. In finance terms, this is called arbitrage. You're taking something that's for sale in one context at a low price and then selling it in a different context at the same time or right afterwards at a higher price. So often this takes the form of acquiring a property off market. You think you have the ability to buy something that's not listed for sale. It could be a friend's house, could be someone who you know is in a distressed situation, or it could be that you go out and you try to find people who are willing to sell their houses cheap. Frequently, the advantage that you have here that lets you do this is that you can pay them cash instantly. And perhaps you will not even close through escrow. Perhaps you will do it without title insurance. You will simply write them a check in exchange for a deed instantly. If you can do that, and if you're very comfortable that you're getting what you think you're getting, then you can sometimes acquire properties for far below market value and then immediately resell them on MLS or to a property investor at a significantly higher price. And so essentially you're taking a few percent to maybe upwards of 20 or 30% even on this deal in an extremely short period of time. And so if you're good at this and you have the right connections to make it work, people can make a lot of money at that.
And sometimes people will end up actually doing some kind of seller carryback. So you're not even really paying the money to get the deals done.
Yes.
Those are sweetheart deals. They're super rare. And if you can find them, good for you. But they're also really risky.
Yes. One optimization of this process is to not even take title to the property. You get it under contract where your contract terms, yes, it's a put option. You have the ability to place that property with somebody, or, it's a call option either way, but it lets you lock the property up and then transfer it directly from its prior owner to its future owner without you ever actually taking title. The catch to that is you are almost always going to have significant risk during the period where that contract is pending. So you get it without having a double transfer, but you're still carrying the risk. And that's why I think it still constitutes a real estate investment.
Agreed. Any type of these options, there's mix and match. They all have their own flavor and they all have their own variations. So if you're comfortable with doing them, great. But this is also why it's important to consult with other people. There are people that do this professionally, and a lot of people are willing to give you a lot of free advice. So, don't feel like you're doing this alone or that you have to make all the mistakes on your own for the first time to learn.
Yes. Now, speaking of people who have a lot to say, this is an industry where there are tons of self-proclaimed real estate gurus who make money doing seminars and selling books and selling information programs and coaching sessions and all kinds of stuff online. And if you get involved in this kind of stuff, you will be bombarded on social media with ads for these people and their programs. Here's the thing. Many of them are good. Most of the people who are pushing that kind of information are, in fact, successful real estate investors.
Nuggets of gold.
Nuggets of gold. Many of them are not necessarily super polished, and it can feel kind of, maybe a little scam-like or not super professional in terms of the way the information is delivered. And you got to take most of it with a grain of salt, because many of these people do not have financial education formally. They don't necessarily have business degrees or finance degrees or experience in commercial environments doing large-scale real estate investment. So there can be a certain lack of rigor in the approaches that they advise, but that doesn't mean it's bad information. What it means is you can learn from them, and you should learn from them, but you should learn from a bunch of them. Don't take any one at face value. Sign up for a bunch of programs, buy all their books. The books are cheap. Read them all, and take the nuggets, because the nuggets are worthwhile. The fact of the matter is, it's not that hard to make some money in real estate investment. Real estate can be a very good investment, and it's not always super complicated. Compared to an awful lot of other areas of business, it can work out really well, even if you don't have a lot of formal education in it. So learn from these people, but don't buy in all the way to any one person's cult of personality. That's important. So
they say weird stuff sometimes.
Yes, they say weird stuff like speculating isn't investment. That's a big one. There are a number of gurus who say that speculation on real estate isn't real estate investment. I have a huge problem with that. In my humble opinion, that is bordering on dangerous advice, because it creates a mindset where you think that you can draw a line between some kind of investing activity and whatever you characterize as speculation. The idea being that if you buy a property that you're going to rent and you're going to get income on it, and you plan the deal based on the income, that now you're investing, you're not speculating. Well, here's the bottom line. Any asset that you own, you are speculating on. If you hold title to real estate, you are speculating on the future of the market. If the market goes up, you reap those benefits, and that's great for you. But if the market goes down, you take those losses. Even if you didn't want to be speculating, even if you didn't plan on the asset increasing in value, even if you underwrote the whole deal and planned it all based only on your rental income and assumed that you would never sell it for $1 more than you paid for it, if the market goes down, you were speculating, and you're going to learn that you were speculating. So never believe that you can own something as an investment without simultaneously speculating in the future of the market on that asset, because you can't. Now, does that mean that you should plan for increases in asset value? Well, I think realistically, you can plan for inflation to increase asset values. I think you can look at conservative market increase numbers. But if you're looking at the Phoenix market over the last 2 years and assuming that that trend is going to continue, you should probably not rely on that to underwrite your deals. It's been great for people who were in at the right time, but you should plan on using your cash flow and rental income to make it a good investment, rather than assuming that things are going to continue to appreciate the way they have.
Yeah, if you're looking at, what you should value appreciation over, a 10 or a 20-year period or the life of a loan, look at historical data for that specific area, that city, that community that you're in, because it varies greatly from area to area. So even if you're not investing in Arizona and you're in any other state, the advice still applies.
Yes, absolutely. Okay. We're over halfway through here. We've only got 10 minutes left, and we've got a lot of material to cover. So we're just going to go through some of the basics here of how to evaluate a real estate investment. First of all, cash flow versus equity gain. It is possible to have a very good real estate investment that makes you no money during the time that you own it. Not only is it possible, it is common. Indeed, you can even have a very good real estate investment that costs you cash flow. You may have to shovel money into your property every month over the entire life of that investment, and that may still be a very good investment. Well, how the heck is that possible? Here's the deal. If you've got a mortgage on a property and you're paying a mortgage payment every month, that mortgage payment includes principal and interest. The interest is what you're paying the bank for the privilege of borrowing their money instead of using your own cash on that property. Almost always their money is cheaper than yours because you could invest your cash in stocks or in other real estate that also has mortgages on it, with a 20% down payment, borrowing 80%, and you will get a better rate of return on that than the interest rate you're paying the bank, which these days is probably going to be less than 5%. Now, the principal portion of your mortgage payment is still your money. You're taking it out of one pocket and putting it in a different pocket. Now, you don't get to access that principal during the course of the loan unless you refinance it, but out of every monthly mortgage payment, the portion that you pay for principal is still your money. Now, if your mortgage is a 30-year mortgage, like a typical primary residence type mortgage, the principal portion of the mortgage payment is not very large because you're spreading out the repayment of principal over 30 years. And during the first several years, you're paying mostly interest anyways. So you're probably not going to have a negative cash flow investment with a 30-year mortgage. But a lot of investment mortgages are 15-year mortgages. A 15-year mortgage is very aggressive amortization. You're paying a lot of principal every month. You're going to be shuffling a lot of cash from one pocket into this other pocket that's your mortgage equity. And you can very easily end up paying so much principal every month on that property that it eats up all of your positive cash flow. All of the rental income, once you take that rental income and then you pay for all the expenses of operating the property, the maintenance, the insurance, the taxes, the vacancy, everything you've got to pay for. And
you could break even.
Yeah, you could break even
or have to pay.
And you can end up negative. And if that happens, that doesn't mean that it's a bad investment because after 15 years on that 15-year amortized mortgage, you own that property free and clear. So you may have had zero cash flow during those 15 years, but whoa, there you go. 15 years later, you just own that property and you can sell it or refi it. And that was probably a very good investment.
Now, where I see it go wrong is where someone bought a house high in the market. It's lost a lot of equity. They're upside down and they're shuffling money into it every month. That is a bad investment. And that's where people really get into trouble is, spending a lot of money every single month, not having a good cash flow and having negative equity.
Yeah, that can be pretty bad. It's hard to unwind that though. But if you're paying principal payment on a mortgage that's not really building equity because you bought it too high and it's worth less now, that's a bad situation. Fortunately, not too many people are in that situation today in Phoenix, but there was an awful lot of that in 2012 and shortly thereafter.
Yes, so avoid that trap.
Yep, indeed. So what this means is when you're considering a mortgage, interest rate matters more than payment amount. Interest that you're paying on the mortgage, that's money that's not yours anymore. That's going to the bank. So the differential between your calculated ROI and the interest rate on the mortgage, that matters. But the payment amount matters a lot less unless you need to rely on the cash flow from this property to live. Then you got to consider it. But otherwise, you should be looking at how much equity you're building and considering that more. And that often means that you can take a shorter amortization term on the loan, have less cash flow, but get a lower interest rate and higher overall investment performance. So create some spreadsheets and run the numbers on that. All right. Strategy, big picture strategy. One of the most popular approaches to residential real estate investment these days is the BRRRR method. That's BRRRR. Buy, renovate, rent, refi, repeat. This is a proven strategy. It's very popular. Lots of people teach this strategy. There are tons of materials on how to do this strategy. And that's because it is one of the most effective ways for an individual to start with one or two properties or with just a down payment or two worth of money and end up with a real estate portfolio of some substantial size in just a few years.
Now, down payment is not, 3%. Like no. We're talking 20%.
Yes.
better 30.
Yes, and you've got to have the money to do renovation. Either that
cash.
or you need a very favorable lender who will loan you money to buy a property plus the money to renovate it based on a projected after repair value. Some local banks will do this. Some online lenders will do this. Some of your friends will do this for you on a hard money loan. But here's the approach. You buy a property that sucks. The more it sucks, the better, generally. You want something that is the worst house on the block or close
In a good
to
neighborhood.
it, in a good or up-and-coming neighborhood. Up-and-coming is even better. You then renovate that property to improve its rental value. Do affordable, nice renovations. Make it a clean, attractive, but affordable rental. You're not making it the top of the market. You're making it on par with the other recently renovated properties in the area.
So don't put black marble everywhere, on the floor, all over. Like, make it so it's very clean and people can move in.
Cost effective. The less money you spend on that renovation to make it look nice and attractive to your potential tenants, the better. Make it very cute. Then rent it.
But not too cute.
Not too cute, just cute enough. Then rent it. Rent it to a good tenant. If you're not experienced in property management, get a local property management company with a good reputation to handle it for you and pay them. Get it rented. Then refinance that property.
You have rent rolls.
You have rent rolls. It is a solid investment property that's just been updated and it is occupied. It is now worth far more than you paid for it. Refi it at 80-20. Take out 80% of that equity. Now you have cash again. That's the repeat part. Take that cash, use it as a down payment on another bad property, use more of that cash to renovate that property, get it rented, refinance it, take the cash out. Repeat this process on an ongoing basis. If your properties increase substantially in value because the area has improved greatly, then you win on speculation also, and you can refi those properties again.
Or sell.
Or sell them. Yep, you can sell them and cash out, use that higher cash value to purchase more properties, and so on. The key is to keep this rolling as quickly as possible. Expand your empire very quickly.
You can end up with $1 million worth of real estate after 2 or 3 transactions.
Yes. The key is that as long as you're maintaining approximately an 80-20 loan balance on your portfolio overall, you are controlling 4 to 5 times more real estate than the amount of equity you've got in it. So if you start out with $200,000 in equity going into this project, you can control approximately $1 million in real estate right away. If you end up with $1 million in equity in your portfolio after about 5 years, you can control approximately $4 to $5 million in real estate. You get the benefit of the investment return on all of that real estate, a $4 or $5 million portfolio, despite only having $1 million in equity in it. And these are achievable numbers in a matter of just a few years for someone who starts out with their primary residence worth of equity. People do this. It works. It is a lot of work.
It is investing. It's not passive investing. You have to be aware, you have to know the numbers, and you have to pay attention. So spreadsheets are your friend. If you don't like math, there are plenty of courses online that can help you navigate this process. A lot of them are free. There are a lot of people willing to help you work through the numbers, but you actually have to understand what you're doing. This is not a this is a gamble. You know, if you're trying to make money, this is a business.
Yep, absolutely. So you're going to run into a lot of rules of thumb in real estate. Things like the 50% rule. Half of your operating income from a property should cover operating costs other than the loan payment. Okay,
Cool.
That's nice. But in reality, that can vary from 40 to 60%. And knowing where your threshold is for that to work out is critical, and it depends on the particular property and the market. The 2% rule. Your monthly rent should be about 2% of the purchase price. Oh, but in some markets, 1% is good enough. Well, you know, that's a 50% range of variation there. So you got to know your particular market. The 1% rule, annual maintenance on a property is about 1% of its market value. Well, that depends an awful lot on the specifics of where you're located. In Central Phoenix, it's probably going to be less than that. In a low price rural market, it's going to be a lot more than that. The 70% rule, for a value add property, pay no more than 70% of the after repair valuation for your initial acquisition plus the repair cost. Okay, but sometimes 20% would be a decent deal, and sometimes 30 to 40% differential is still not going to be good enough. So the bottom line here is
you got to know the numbers.
Rules of thumb are not good enough to really evaluate a deal. Rules of thumb are very general. And what you really need is a detailed spreadsheet full of actual numbers for each individual property. That is the work of real estate investing, is determining whether any one individual deal is a good deal or not.
So use your rules of thumb, create another analysis that uses more realistic numbers for what you're doing, and then have your pessimistic one.
Yep. 3 sets of numbers if you can, and don't make your optimistic one too optimistic. If you totally beat your optimistic numbers, that's excellent, but it does you no good to have a spreadsheet in front of you that's making you feel better than you ought to about a project. You need to have pessimistic numbers that are realistic and expected returns that are also realistic. Bottom line is to reject questionable deals. If you want to make money in real estate, just like in any other aspect of business, your number one job is to turn down bad deals. And most deals are bad deals. Most options that you have are not good options. Your job is to pick the 1 out of 10 or 1 out of 100 in some situations that is the best possible deal among all of your options. The best possible deal. That's how you win. There you go.
Well, we hope you found this helpful. And if you've got questions, we've got answers over at AZ Own It. So we are with Realty Executives, the AZ Own It team. You can find us online at azownit.com, or you can give us a call at 480-400-1297. Thank you for listening to the Lawgitimate podcast, and we will talk to you next time.